morning, students. I welcome all of you to the fourth lecture on bond prices and bond yield. So the previous sessions we have gone through types of bonds and the difference between bonds and equity. Then we looked at different types of bonds that a company can issue. Then we have seen in a light mode, we looked at the bond price, what are the various components of calculating bond price. So before we take up today, the lecture outcome is the bond price, what is bond price and how we can compute bond price, and then what is the relationship between bond price and yield, the relationship between bond price and yield. So these are three different topics that we are going to look at today's session. First of all, before we look at the bond price, we need to look at the fundamentals of bonds. We have seen earlier on a lighter mode. Again, we will go through it. Bonds are having a fixed maturity period. It doesn't have a perpetual mode. It has got a fixed maturity period. It carries fixed rate of interest. That interest we call it as the coupon rate of interest. Then it has got a face value. Face value means the price at which the bond is redeemed after the maturity period. The redeemable value. The redeemable value is called the maturity price, or it's called face value. So maturity value, or redeemable value, or face value, or one and the same. Then another important thing we need to look at is what is the required rate of return? What is the required rate of return? So when the bond holder is investing in bonds, he is expecting certain rate of interest. Though the company is giving, say, 12%, he may expect, say, 10% or 15%. So what is his expectation from the bonds investment? So that is called expected rate of return. So the expected rate of return is used for computing the bond price. So these are all the important components while we calculate bond price. We need to have face value, 1, 2, coupon rate of interest, 3, interest as such. The interest is calculated always on face value. Then fourth one is the maturity period. After some point of time, the bond is being redeemed. So that is called maturity value or maturity period. The fifth one is the required rate of return, which is used for calculating the bond price. The bond price is the sum of the the present value of interest payment and the maturity value. The sum of the present value of interest payment and the maturity value is called the bond price. So the present value, as we have seen earlier, it is used for calculating what you are receiving the interest after 2 years, or you are receiving the interest for 3 years. So what is the price? What is the value of that interest payment today? So for example, when we invest in bonds, the company will not pay the interest amount immediately. The company will pay the interest amount after 1 year. So the bondholder will receive the interest after 1 year or after 2 years. So what is that value of interest today? That is called the present value. The present value of the interest payment. Then after 5 years, say the maturity period is 5 years, 1,000 rupees the bond value. So after 5 years, the 1,000 rupees is given back to the bondholder. So what is the value of that 1,000 rupees today? So the sum of these two is called bond price. The equation here is, I write bond price is equal to interest payment divided by 1 plus r power t, sigma 1 plus r power t T is equal to 1 plus maturity value divided by 1 plus R power n. I repeat, bond price is equal to sigma I divide by 1 plus R power T. T is equal to 1. T is equal to 1. So first year, second year, third year. So R is means the required rate of interest plus M is the maturity value divided by 1 plus R power n. So what is I? I is called the interest amount. I is called the interest amount. T is called the time period. T is called the time period. That means 1, 2, 3. That is N is called maturity period. N is called the maturity period. Then R is called required rate of return. Required rate of return. So I repeat, I is called the interest amount. The interest amount is calculated always on the face value of the bond. The interest is always calculated on the face value of the bond. T, time period, it can be 1, 2, 3, but a 5-year period, 1, 2, 3, 4, 5. N is the maturity period, that is 5 years. R is called the required rate of return. That is, what is the expected rate of return by the bondholder on the investment, on the bond investment. That is called the required rate of return. M is called the redeemable value or the face value of the bond. So any clarification before we take up the case? Bond price. So there are five important components to calculate bond price. 1, coupon rate. 2, interest amount, that is I. I is always calculated on face value of the bond at the coupon rate of interest. Okay. M is maturity period, maturity value, that is the face value of the bond. Then required rate of return. These are the 5 important components of calculating bond price. So how do we calculate? The sum of or the aggregate of the present value of the interest payment and the maturity value of the bond. That is called the bond price. So how do we calculate? I divide by 1 plus R power T plus M divide by 1 plus R power N. So since we are calculating the present value, we are dividing it. To calculate the future value, we need to multiply. So any clarification? Anybody? Shall we proceed with the case?
Yes, sir.
Yeah. Okay. So it is there, the LMS, it is there. You can just go through. It is there. I don't want to read that. So look at the case here. A simple case for you to understand the bond price. What is the first one? Yeah. It is given here. What is the price of the bond? The required rate of return is 6%. 1 minute. Before that, it is given. Yeah. Okay. So you can write. Those who have notebook, please note down. Please note down. It is there. What is the price of 6.5%? All of you can see that it is there in the. It is there already. All of you can see that.
Yes, sir, we can see.
Yeah.
Yes, sir.
What is the price of a 6.5% annual coupon bond with 1,000 face value, which matures in 3 years? The required rate of return is 3.9%. So what are the information given? The information given are 6.5%, that is the coupon rate of interest, 1,000 rupees, the face value of the bond, maturity period 3 years, and the discount rate of return, the required rate of return is 3.9%. Got it? Now, what is the interest amount? The interest amount is 6.5% on 1,000 rupees. 6.5% on 1,000 rupees. So that means 6.5 into 6.5 divided by 100 into 1,000, 65 rupees. 65 is the interest amount. The required rate of return is 3.9%. That is the rate at which, that is the expected rate of return by the bondholder. Though the company is giving 6.5% interest, he is expecting 3.9%. 3.9% rate of interest. Then you may ask, sir, why he is expecting less? That is his expectation. That is his expectation. That is 3.9%. So after the 3 years period, the money will be given to him. That is 1,000 rupees will be given to him. That is called the face value of the bond. So we will calculate. That is I is equal to, the interest amount is 65 rupees. 65. The face value of the bond is 1,000. Maturity period is 3 years. Required rate of return is 3.9%. So how do we calculate? That is 65 divided by 1.039 power 1. 1.039 power 1. That is the required rate of return. 3.9 divided by 100. 3.9 divided by 100 is 0.039. So 1 plus R. So 1 plus 0.039. That is 1.039 power 1. 65 divided by 1.039 power 2 plus 65 divided by 1.039 power 3 plus, this is what the interest amount plus 1,000 divided by 1.039 power 3. So he will get back 1,000 rupees after 3 years. So what is the value today? So 1,000 divided by 1.039 power 3. So please give me the answer. 65 divided by 1.039. Anybody? 65 divided by 1.039. How much comes? 62.560 plus 65 divided by 1.039 power square. 65 divided by 1.039 power square. How much comes? 60.24 plus 65 divided by 1.039 power 3. How much comes? You can take two decimal. Take two decimals. Don't take more than two decimals. Two decimals is enough.
So 58.03.
58.03 plus 1,000 divided by 1.039 power 3.
892.85.
892.85. So total how much?
So 1,073.68.
1,073.68. So please listen. Kindly listen. The 65 rupees what the bondholder is receiving after 1 year, the value today is 62.560. So this bondholder will be receiving 65 rupees after 1 year. So what is the value today at 3.9%? The value today is 62.560. After 2 years, he will be receiving 65 rupees, second year interest. So what is the value today at 3.9%? That is 60.24. After 3 years, he will be receiving 65 rupees. What's the value today? At 3.9%. That is 58.03. After 3 years, he will be receiving 1,000 rupees. What he invested today, he will be receiving after 3 years. So what is the value today? The value today is 892.85. That means the bond price what you are going to invest today, after 3 years, you will be receiving, after 3 years, there's a future value. After 3 years, you will be receiving 65 into 3 plus 1000. So you will be receiving 1000 plus 65 into 3, that is 195 plus 1000. So you will be receiving 1195. After 3 years, you will be receiving 1195. So what is the value today? The value today at 3.9% is 1073.68. The value today, what is today's bond price? The today's bond price is 1073.68 at the rate of 6.5% coupon rate. The required rate of return is 3.9. All of you understood? Is that clear?
Yes.
The logic is what? The logic is what is the value of the bond today? Today, what is the price? At 3.9%. So at 3.9%, the value today is 1073.68. Is that clear? Any clarification? Anybody? So how to calculate bond price? So to calculate bond price, these information you will get. Coupon rate, maturity value, required rate of return, maturity period. So these 4 information will be given. So from these 4 information, calculate the interest amount. The interest amount is calculated always on face value. The interest amount is calculated always on face value at coupon rate of interest. Don't take required rate of return. Take the coupon rate to calculate the interest amount. Then to calculate the bond price, we require required rate of return. So we are, yes.
So maturity value also will be face value, sir?
Yeah, maturity value is always face value if nothing is given. So it is assumed that face value and maturity value are one and the same unless it is specifically mentioned. So for example, zero coupon bonds. So zero coupon bonds maturity value will be higher because it is redeemed at higher price because there is no coupon rate of interest. There is no coupon rate of interest. That's why it is called zero coupon bonds. So it is issued at par and redeemed at premium. That is called zero coupon bonds. That means the maturity value and redeemable value are not one and the same. Predominantly, face value and maturity value, redeemable value are one and the same. Anybody? Any more clarification? Shall we proceed further?
Yes, sir.
Okay. Now, look at the next case. Look at the next case. Now, the same question, same thing. The required rate of return is 6.5. Earlier the required rate of return is 3.9. Now, the second case, the required rate of return is 6.5. So, please take next one. I is 65, same, 6.5. Coupon rate of interest is 6.5. F is 1000, maturity is 3 years. So that is R is 6.5. 6.5%. So with the R is 6.5%, so what is the bond price? What's the value of the bond? So bond price or value of the bond are one and the same. Value of the bond or bond price, the term would remain same. So now calculate that. That is 65 divided by 1.065 power 1 plus 65 divided by 1.065 by 2, 65 divided by 1.065 by 3 plus 1000 divided by 1.065 power 3. How much comes?
Sir, 1.6.5, how it becomes 1.065?
Oh, sorry. Huh?
Explain that.
1.065,
065, no? I plus R is equal to 1 plus 6.5 now. So how it becomes 1.065? I have a confusion in that figure.
6.5 divided by 100. How much? 6.5 divided by 100. How much?
Yeah, okay, sir. Now it's clear.
Clear, no?
Yeah.
6.5 divided by 100 is 0.065
Plus 1.
plus 1. 1.065. Earlier, the previous case also 3.9. So 3.9 divided by 100. So 0.039. So 1.039.
Okay, yeah.
Yeah. So 65 divided by 1.065 power 1. How much?
61.0328, sir.
60?
1.03.
61.0328.
0328.
61.0. No, you can make it 2 decimal. So 61 point,
03, sir. 03, sir.
61.03
Yes, sir.
plus 65 divided by 1.065 power 2.
57.531.
57 point,
531.
57.53. No, make it 2 decimal only.
Yes.
So 57.53. Okay, plus 65 divided by 1.065 power 3.
54.16.
54.16 plus 1000 divided by 1.065 power 3.
833.34.
833.34. So total
1006.05.
1006. Should be exactly, because of the decimal, you don't get the value. So the value is 1000 rupees only. The value is not 1006. Because of decimal, I think 6 rupees you are getting more. So the value is more or less 1000 only. If you take exact decimal, then you may get 1000 exactly 1000. Okay? So instead of writing 1006, you can write 1000, because if you take exactly as per the decimal value, you will get exactly 1000. 6 rupees is relatively higher. Kindly check the decimal. 6 rupees is a little higher. Just check the price, check the value.
So it will be 999.99.
Yeah, that's what I'm saying.
And
But somebody said
1000 divided by will be 827.8.
827.85.
85.
Yeah, it should be 1000 only. 827.8. 827.85, no?
Yes, sir.
That is right. 1000. Okay. So now, I repeat, at R is equal to 3.9. At R is equal to 3.9. What is the value of the bond? We calculate 1070. How much we got? The previous one? The previous one, how much we got?
73.
1000?
73.
1073. When R is equal to 6.5, it is 1000. The bond price is 1000. Okay? Now, let us take the third case. Let us take the third case. What is the price of the bond? The required rate of return is 15%. The required rate of return is 15%. Okay? Once again, R is changing. R is 15%. So R is 15% means it will be 1.15 power 1, 1.15 power 2, 1.15 power 3, 1.15 power 3. So how much comes? So first one is 65 divided by 1.15 power 1. Second one is 65 divided by 1.15 power 2. Third one is 65 divided by 1.15 power 3. Fourth one is 65 divided by maturity value is 1000 divided by 1.15 power 3. How much comes? First one. First one is how much?
56.52, sir.
56.52. 56.52 plus 65 divided by 65 divided by 1.15 part 2.
49.24.
49.24 plus 65 divided by 1.15 part 3.
42.76.
42.76. 42.76 plus 1000 divided by 1.15 part 3.
657.89.
657.89. How much comes?
So the rate at which the investor is expecting.
Very good. The rate at which the investor is expecting.
Yes.
Okay, good. Jyoti Sharma, where is he? Salim? Salim is there? Hello? Salim, 502083. Salim, 502083. Salim, he's there? 502083. Salim. So 502083 Salim absent. 502083 Salim absent. Salim absent. Sneha?
Yes, sir.
Okay. Vijay Krishna? 502095. Hello?
Yes, sir.
Okay. What are the fundamentals of bond price calculation? Fundamentals of bond price calculation. Fundamentals of bond price calculation. Or there? Devadiya? Devadiya Sandesh.
Sir. Yes, sir.
Okay. How are you?
Fine, sir.
What is the fundamentals of bond price calculation?
So the coupon rate, required rate of return, face value,
Okay.
and the interest.
Okay. One more? Okay. Required rate of return, face value, coupon rate. Okay.
Coupon rate interest.
Okay. Okay. Chaitra?
Yes, sir.
Now, at 3.9%, at 3.9%, the value is 1073. The bond price is 1073. At 6.5, the bond price is 1000.
Yes, sir.
At 15%, the bond price is 805. Say 806.
Yes, sir.
What do you infer from here? What is your interpretation? What is your conclusion from this? R is equal to 3.9. The value is 1073. When R is equal to 6.5, the value is 1000.
Yes, sir.
When R is equal to 15%, the value is 806. So what do you interpret?
As the rate increases, the amount is decreasing, sir.
Okay, why?
Because the rate is increasing, no, sir.
Rate?
Is increasing.
The rate is increasing, the value is decreasing. Correct? Why I am asking is why? Why it is decreasing? The rate is increasing, why the value is decreasing? Anybody? Ajit? 503133. Ajit? Hello? Ajit is there?
Sir? Yeah, sir.
I mean, the rate is decreasing, but the value is decreasing when the required rate of return is increasing. Why is it so?
Sir?
Ah. Abhishek Kumar, 3136. Abhishek Kumar. Abhishek Kumar is decreasing. The bond value is decreasing. When the R is, look at the answer that we got. When R is equal to 3.9%, the value of the bond is 1073. When R is equal to 6.5%, the value of the bond is 1000, which is equivalent to maturity value. When the R is equal to 15%, the value of the bond is 806. Why is it so? When the R is increasing, the value of the bond is decreasing. When the R is decreasing, the value of the bond is increasing. When R and I, the coupon rate, are same, the value of the bond and the maturity value are one and the same. When R and I, that is coupon rate, are the same, then the value of the bond and the maturity value are one and the same. So 6.5 is the coupon rate, R is also 6.5, the value of the bond is 1000, which is equivalent to the face value of the bond. When the R is increasing, the value of the bond decreases. When the R is decreasing, the value of the bond is increasing. Why is it so?
Sir, is it for new issue the value goes down?
No, it is for, see, you take any bond price in the market, when the R is decreasing, the value increases. When the R decreases, the value increases.
Because
But-
cost side of borrowing is increasing, that's why the price is coming down.
Which one?
So because the cost of borrowing is increasing, that's why the
So I have not talked about cost of borrowing at all.
So is it because of the risk factor, sir?
What risk factor is here?
Is it because when the price increase, the required rate increases, the risk also increases?
Why? What is the risk factor here?
Investment on the bond, sir.
Okay. The investment of the bond is always risky. So that we are not taking into account at all here. Think.
I think bonds have an inverse relationship with the interest rate, sir.
Okay, that is right. That's right. That's the first theorem.
So what I think is when newer bonds come into the market,
Okay.
the older bonds, their value decreases in the eyes of the investors. So the investors always prefer especially.
No, look at. Don't think beyond your capacity. You are thinking beyond your capacity. I mean, you look at the first one. You look at the first case. Look at the first case. You have divided by 3.9. 1.039. Correct? When you come to second one, you have divided by 1.065. 1.065. When you come to third one, you have divided by 1.15. So what does it mean? What does it mean? What does it reflect? What does it reflect? So I repeat again, as I was telling you earlier, the beginning of session itself, the bondholder is receiving after 1 year. The bondholder will be receiving the interest after 1 year. The bondholder will be receiving after 2 years. So what is the value today? What is the value of that cash flow today? So the cash inflow for the bondholder, cash outflow for the company. Cash inflow for the bondholder, cash outflow for the company. The company is giving the interest, bondholder is receiving the interest. So for the bondholder, it is cash inflow. For the company is paying the interest, so it's a cash outflow for the company. And after the maturity period, the company is paying back, there's a cash outflow. And for the bondholder is receiving the back money, it is a cash inflow. Okay? So look at in that perspective. So what happens?
It may be because investor is expecting less return
Okay.
than the actual return provided by the company.
Okay. So-
if like thousand for 1,039 rupees he will be expecting, but he will be getting 1,065.
Okay.
So it may be because the present value changes, sir.
Very good. The present value, that's what we looked at. What is your name?
Sandesh, sir.
Huh? Devadiga.
Sandesh. Devadiga.
Devadiga. Okay. Devadiga, you got 1 mark. Huh?
Thank you.
Earlier you didn't get, no? Devadiga?
No, sir.
Okay. So you have to get another 4 more marks. Okay. So look at that. The cash inflow, when the rate increases, the present value of the cash inflow decreases. When the rate increases, the present value of cash inflow decreases. The rate what I meant is the required rate of return. The required rate of return decreases, the present value of cash inflow increases. I repeat, the present value of cash inflow increases when the required rate of return is decreasing. Because you are dividing it by 3.9. So when you are dividing it by 3.9, cash inflow increases. Cash inflow increases. So the present value of the bond increases. When you divide it by 15%, because when you divide it by 15%, the present value of cash inflow decreases, and thereby resulting decrease in value of the bond. The first theorem that we are talking about today, bond theorem that we are talking about today, bond price and yield are inversely related. Bond price and yield are inversely related. One girl told me, when we are discussing bond price and value are inversely related. Who is that girl?
Sir, it's me, sir, Jinsi.
Jinsi, you will get 1 mark. Huh?
Thank you, sir.
So you are first time, no? You are getting 1 mark?
Yes, sir, yes.
Okay. So 4 more marks. Okay. Though, I don't know how she has said that. She might have read it earlier. I don't know. Bond price,
Sir?
the first, yes.
Excuse me, sir.
Yeah.
Sir, in the previous class, you have mentioned it, sir. I have noted it down.
Oh, very good. So bond price, the first theorem that we are talking about today is the relationship between bond price and yield. The relationship between bond price and yield. This is a price, yield. Y-axis is the price, x-axis is the yield. When the bond price decreases, while the yield, when the yield increases. Okay? So the bond price and yield are inversely related. Please keep in mind. This is a simple thing that we need to, very, very simple thing, but very, very fundamental in calculating the price. The bond price decreases. When yield is increasing. Yield, what I meant here is the required rate of return. Yield decreases. The bond price, yield decreases. When the yield is decreasing, the bond price increasing. So please write. You can note down. Bond price and yield are inversely related. You know that? Point number one. You can take those example. When R is equal to 3.9%, the value of the bond is how much? 1078, no? What is that? We got
1073 is the
1073 point. How much we got? Something we got. 1073 point? 1073.68, correct, no?
Yes, sir.
Yeah, 1073.68. When R is equal to 3.9, that is value of the bond is 1073.68. Second one, when R is equal to 6.5, when R is equal to 6.5, the value of the bond is 1000. The value of the bond is 1000. Third one, when R is equal to 15%, the value of the bond is, how much we got? 806, 805.
806.
Oh, 806. 806. Okay. Now, theorem number 1. 1. When I is equal to, bond price, interest rate. The interest rate is 6.5%. R is equal to 3.9. When I is equal to greater than R, when I is greater than R, when I is greater than R, the value of the bond is greater than the face value of the bond. When I is greater than R, the value of the bond is greater than the face value of the bond. Please write. Continuation. You can write continuation. When R decreases, the cash inflow increases, the present value of cash inflow increases. When R decreases, the present value of cash inflow increases, and thereby the value of the bond is increasing. And thereby the value of the bond increases. Some of you can read first sentence. Anyone can read the first sentence? First theorem. Hello? When
interest rate is greater than the
R, okay.
the value of the bond is greater than face value of the bond.
Okay. All of you understood? This sentence all of you understood? The value of the bond is greater than the face value of the bond, because the value of the bond is 1073 and the value of the face of the bond is 1000. The value of the bond is greater than the face value of the bond. Full stop. Second sentence.
When R decreases,
when R is decreasing,
the present value of cash inflow increases.
the present value of cash inflow increases. When R decreases, the present value of cash inflow increases, and thereby the value of the bond increases. Then second one is when I is equal to R. I equals to R. The interest rate equals to R. When I is equal to R, the value of the bond equals to face value of the bond. When I is equal to R, the value of the bond equals to face value of the bond. When I is 6.5, R is 6.5, the value of the bond, that is 1000, which is equivalent to face value of the bond, that is 1000. Then third one, when I is less than R, okay, so I is 6.5, R is 15%. When I is 6.5, R is 15%. When I is less than R, please write, the value of the bond decreases. Because the present value of cash flow, decreases. The present value of cash flow decreases, and thereby the value of the bond decreases. Okay. Continuation. The value of the bond decreases. The value of the bond decreases when R is greater than I. When R is greater than I. When R is greater than I, or when I is less than R, the value of the bond decreases. Is that clear? All of you? So the price of the bond and the yield of the bond are inversely related. Price of the bond and yield of the bond are inversely related. When the R increases, the value of the bond decreases. When R decreases, the value of the bond increases. That means when R, the first category, we call it as a premium bonds. The first category we call it as a premium bonds. That means when the R decreases, the value of the bond increases. Those bonds are called premium bonds. Why it's called premium bonds? Because the value of the bond is greater than the face value of the bond. They are called premium bonds. The second category of the bond is called par bonds. It is equivalent. Par value, the face value is equivalent to value of the bond. That's called par bonds. The third category we call it as a discount bonds. So what does it mean? The value of the bond decreases when R decreases. That means the face value of the bond is greater than the value of the bond. That means the value of the bond is less than the face value of the bond. So those bonds are called discount bonds. The first category is called premium bonds. Second category is called par bonds. The third category is called discount bonds. So any clarification, anybody? So we have seen today three things. One is the fundamentals of bond price calculation. Second thing is we have calculated the bond price at three different levels. And we looked at a very important theorem, the relationship between bond price and yield. So the bond price and yield are inversely related. So we just got three subcomponents. When R is equal to I, when R is greater than I, when R is less than I. Any clarification? Anybody? Anything you want to ask? I don't want to stuff many things because these are all very, very simple things that we need to understand when we move forward with the big case studies. Because they are very, very fundamentals when we are taking up the big case studies, because these are all things these are all concepts that we look at the subsequent sessions. So this particular session is very, very important because this is very, very always. We may ask the questions after 15 sessions. We may be asking the same question: why bond price and yield are inverse related? So please look at that. Please, this is very, very important. So you should have a very, very strong base in this. So any clarification, anybody? So keep in mind, very simple thing. When the discount rate increases, the present value of cash inflow decreases. Discount rate increases, the present value of cash inflow decreases. That means the value of the bond decreases. When the discount rate decreases, the present value of cash inflow increases, and thereby value of the bond increases. Okay. So if you get higher, if you receive more interest rate, see for example the third case, what is that? Third case, if it is the coupon rate increases, certainly you will get more interest. But the required rate of return decreases only, you will get the value of the bond will be higher. Then only you will receive, then it's called premium bonds. Okay. So any clarification, anybody? Any clarification, anybody, anything you want to ask? All of you understood clearly? Anything you want to ask? Any clarification, anybody? Jibin, understood? Hello? Jibin?
Yes, sir.
Clear?
Yes, sir.
Clear?
Yes, sir.
So what are called premium bonds? Premium bonds.
So the bonds which are priced more than the face value.
What is that? Say once again, so differently.
Sir, when the actual amount, when the bonds are priced more than the actual amounts, it is called premium bonds.
No.
It is,
Required rate of return. The required rate of return is, say for example 3.9 and the coupon rate is say 6.5. So the coupon rate is greater than the required rate of return, or the required rate of return is less than the coupon rate of return, then those bonds are called premium bonds. So keep the first one. First one is coupon rate is how much? 6.5. The required rate is how much? 3.9. They are called premium bonds because the required rate of return is less than the coupon rate. Got it? Jimin?
yes, sir. Yes, sir.
That's what you need to say. I mean, premium bonds means the required rate of return is less than the coupon rate. Put it in other words, the coupon rate is greater than the required rate of return. Got it? So you should say that answer. Don't say, coupon rate, you should not say the value of the bond, all that. Value of the bond depends on the required rate of return. Not the other way around. The value of the bond depends on the required rate of return. The required rate of return changes. It can be, equivalent to coupon rate, or it can be more than coupon rate, it can be less than coupon rate. There are three situations. The required rate can be more than coupon rate, or less than coupon rate, or equal. The required rate, if it is more than coupon rate, then the value of the bond decreases. Value of the bond decreases. When the required rate of return is equal to coupon rate, value of bond, face value of bond, same. When the required rate of return is less than the coupon rate, the value of bond increases. Is it clear?
Yes, sir.
Yeah, that's what you should say. Mamta, Sri,
Yes, sir.
what are discount bonds?
Sir, discount bonds are when it is the rate of return is more than the coupon rate, sir.
The rate of return is more than coupon rate. Very good.
Yes.
Very good. Okay. So thank you very much.